Good evening, ladies and gentlemen. You're watching India Tonight with me, Sumita Karir, and my co-host Nivedna Prabhu. We're coming to you live from the Delhi studios. In fact, our top story tonight, while the Federal Reserve is all set to cut interest rates by a quarter point, but the bigger question for the markets is what comes in next. Treasury Secretary Scott Bessent is urging a deeper move. He's stating that the Fed has been behind the curve. So while dissent amongst Fed governors is possible, traders are betting on two more cuts before this year ends in October and December. And to discuss more on the key expectations, we're now joined by Mr. Ajay Bagga, who's a market expert, and Arnab Das, who's a global macro strategist, EMEA Invesco. Thank you very much, gentlemen, for taking the time out and speaking to us here on ET Now. Nivedna, lots to discuss as far as this particular story is concerned, the key expectations more importantly.
Absolutely. In fact, considering the fact that you've already welcomed the both of them, but let me also take the opportunity to thank both of you for taking the time out. But Mr. Das, let me begin with you. Given the fact that how we've looked at Donald Trump also pressurizing the Fed, how are we essentially looking at this? First things first.
Well, look, I think this is a new kind of challenge, or at least it's a challenge that hasn't taken place in the U.S. since the 60s and 70s against the Fed. So I think it is, somewhat uncharted territory for most people in the markets. I think there's a big difference between then and now, mainly that back then it was about juicing growth. Whereas now there seems to be a bit more of an element of what they call, fiscal dominance, that at least the president himself is quite clear about, that he would like lower rates, among other things, especially to lower the cost of the U.S. public debt, the federal debt in particular. I think, what is most striking to me about this is the disconnect, if you like, between the way that the market has sort of priced in a deeper, earlier rate cutting process, with more or less 50 basis points priced in for now, but has not priced in any meaningful increase in inflation expectations in the longer term. Right, so there's been some yield curve steepening, of course, as they call it, right? So long-term bond yields have gone up more than short-term bond yields, which have gone down because of this expected easing by the Fed. But if you look at the market for inflation-protected bonds in the U.S. versus the ordinary bonds, there isn't a big increase in inflation being priced in, nor are investors demanding disproportionately more for buying longer-term debt as opposed to rolling over short-term debt. That's called the term premium. And these are the two things that would show you, I think, most explicitly that there was a serious problem that the market was scared of. I think that fear is there in the conversation in the market, and that fear is, kind of being stoked by these challenges with the Fed. But I think the market's assessment overall, and I sort of share this, is that they won't go too far. Because in part they were elected on a ticket that was substantially about the Biden era inflation, right? So they won't go too far to push the Fed into easing prematurely, and I don't think the Fed would deliver that anyway. Although I do sort of agree with the pricing again in the short end that the Fed is becoming more dovish, perhaps for good reason, because there are significant indications of a slowing labor market, albeit that some, inflation stickiness is keeping the inflation rate above the target at the moment. So it's quite a complicated situation, but on balance, I think, it's probably more or less okay, and in my mind, not as bad as what took place, at least not yet, as in the 60s and 70s.
All right, Mr. Das, that's an interesting comparison that you draw with the 1960s and 70s. Let me come to you, Mr. Bagga. What tone would Jay Powell essentially take at the press conference, and what does that really say about how the Fed is looking at tariff risks that many say are going to have a slowing impact on the U.S. economy?
Yeah, surprisingly enough, the tariff impact has not flown through into the consumer inflation numbers. So that has been a surprise, despite the tariffs largely having come into force. So now without tariffs, the deficit is too high. So after the big beautiful bill, the tariffs are needed to shore up the government finances. That's very clear. So one way of looking at it, what Mr. Das mentioned about the bond market, would be that most market men were not very convinced on the durability of the tariffs. And they thought that these would go away with time. We have seen actually manufacturing jobs going down. Nearly 78,000 US manufacturing jobs have gone off in the first 8 months and 12,000 in August itself. So tariffs and make America great again, I don't know how strong that correlation will really work out. But the government doesn't have the fiscal space not to do the tariffs after the passage of the big beautiful bill, which is giving a lot of tax rebates and is increasing the deficit. Second, Powell's job is nearly impossible. So I would say he was wrong on two counts. One, during the easing at the COVID time, it was hyper easing, hyper QE, which led to a massive inflation. So that whole talk of that 2% and inflation being transient because of the fuel that they were putting in the fire, that proved to be wrong. Second, they have been late now in cutting. So right after December last year, because of the Trump presidency and the policy chaos that came in, they did the conservative thing by standing on the side, but they had very poor data, very poor modeling. So imagine an economy of the size of the US seeing a revision in jobs by 900,000 after 6 months of March 2025. Then we should just put that data in the dustbin if it is getting revised so massively. It just shows that either the reporting is not correct or the methodology is not correct. So I would say, unfortunately, Powell will go down in history as somebody who got it wrong two times over. And today the rate cut comes in. Uh, Again, he will say we are meeting to meeting, we are data driven, but the data is suspect. So what does he do? I would say it would have been better to do a jumbo cut today and say that we are in the catch up mode. Right now, the risk is more on the labor market weakening, but I think they'll go with 25, which is the street consensus. But remember, last year he surprised the market with a 50 basis point cut in September after holding on for quite some time. So we really don't know where it goes. The market is factoring in three rate cuts, as you mentioned, but market has been consistently wrong for the last 1.5 years in the pricing of the Fed policy action. So I would not go with that. I would stay policy by policy as they are being. Those old, very wise central bankers are gone now, whose models used to work. The models are broken. The forecasting is broken. Nobody's forecasting. You and I could run it if it was policy by policy. Just look at the previous month's data and the last 6 months
You
trend
make very
and take a
imperative points
decision.
there. In fact, both Sumita and I will come back to you to decode that further in terms of how we're looking at it and, of course, more about the unemployment data as well. But Mr. Das, I want to stick to the point of the tariff. In your opinion, has that impact also completely been penciled in, and how are we looking at the bottlenecks here?
Look, I think what Ajay Baga said is correct. So far, the tariffs haven't really shown up in inflation. If anything, they've shown up more in growth, and between the tariffs and the immigration policies, there seems to be pressure building and taking place already in the labor market, right? Now, I think what's going on with the tariffs is that, of course, there was an enormous front loading of imports in Q1 before so-called Liberation Day. And of course, Liberation Day, it turned out to be much worse than people were fearing, but then it only lasted about 7 days after which President Trump, sort of stood down on a number of the tariffs. Tariffs are still much higher than they were, but nowhere near as bad as they might have been or were advertised to be. So I think what's happening is that so far, companies have been able to take it on the chin through the inventories that they build up in the front loading. as many people are saying, and to some extent by squeezing margins. Now, whether that shows up, these increases in costs show up later or not, I think depends now a bit on demand, because the supply overhang is working its way through the markets already, through the economy already. So if demand remains on this kind of, sort of treading water trajectory where the economy is softening, the labor market is softening, everything appears to be softening, then maybe the inflation pass-through will be somewhat mitigated, right? Because there won't be a strong economy to pass those price increases, cost increases onto. But if the rate cuts come thick and fast enough to rescue the economy and stoke up demand again, then we might get some more inflationary pressure out of the tariffs in the short term. I think then there's a longer term question here, which is that since the administration intends to rewire the global trading system, and at least to some extent to reindustrialize the U.S., that means that the prices of goods will have to go up relative to the price of services in the future. So we should expect some more of this kind of question about inflation pressure coming through from time to time, plus the immigration side of things imply slower growth and somewhat higher labor costs and wage inflation. Right?
Right, Mr. Das. So let me ask you a follow-up question pertaining to your point about, the trajectory that the Fed could essentially take as far as the rate cycle is concerned. Do you anticipate two more cycles of rate cuts to be factored in, as many analysts are penciling in, at least for the remainder of this year, given the fact that, many suggest that the U.S. economy is headed for a phase of slowdown, and of course there are concerns related to inflation and stagflation as well?
Mm-hmm. Yeah. So I think that is absolutely correct, right? That we are looking at a slowdown with, I would say, stagflation light or even very light pressures coming through, at least so far. Nothing like the stagflation of the 70s, which was caused by a sharp shock in the price of oil twice, right, in 1973 and 1979. I think what we're looking at here is a more gradual process of price pressures in the goods sector as these tariffs come through, and and through, like I said before, through wages as immigration crackdowns and reversals bite to some degree in the labor market. Now, that probably points to a lower growth economy with somewhat higher inflation pressures. So it's really in the Fed's dual mandate, this famous thing, is it about jobs and growth, or is it about inflation, flipping back and forth? And I think what we're looking at here is a case where the needle is shifting maybe more quickly than people had previously expected, from an inflation question to a jobs question. And that, I think, does justify the cutting cycle that's being priced in. Now, I don't think we're looking at a recession here. And, of course, typically in a recession, historically, you get hundreds of basis points of rate cuts in actually quite short order. And then you get a very gradual pace of increases as the economy recovers, right? Much more gradual than the cutting. I think what we might be looking at here is a little bit different, right? A more gradual, phased approach to cuts, albeit that it looks like they'll be more front-loaded and deeper in the front end, because we'll have to feel our way by going through this, since it's really sort of uncharted territory where all these shocks are being thrown at the economy directly by the government, right? I mean, typically what happens in a recession is that something breaks, usually because the Fed has raised rates too much, and there's been a lot of buildup of imbalance in the private sector. Maybe it's household credit, mortgage credit, maybe it's private sector credit, corporate credit, what have you. That's what usually breaks and requires a very rapid rate cutting process. We're not looking at that kind of situation here. What we're looking at, like I said, is, and as everyone is well aware, we're discussing that the government is changing the rules of the game. And so that is a very different kind of macro juncture. And it's more of a structural change than a cyclical change, which is what normally happens that the Fed responds to. So I think we're grappling with a range of complex issues here, for the reasons that were said earlier. Maybe the data isn't good enough, but I think also, besides the data, we're going through rapid structural change. So the models, almost by definition, are not good for that, because when you have rapid structural change, you have a structural break in the data. And so I think it's going to be touch and go. I think data dependency is really the only thing we can go with here. But I do think the needle is moving towards rate cuts rather than holding.
Mr. Das, fair enough, given how we're looking at it from your vantage point. But Mr. Bagga, let me ask you this. For corporate India, does the Fed's pivot reduce external borrowing costs that we are looking at here materially, or will global risks, still remain elevated?
No, definitely, it will reduce costs going ahead. And we are seeing that, especially in the US mortgage market, where rates have come down. So this cut will reduce borrowing costs across the world, and that is expected. And the bond yields are already reflecting it. But guess what? Last week itself, the US got inflows of $40 billion into money market funds, and money market funds are at $7.6 trillion of AUM. So historic highs, lot of liquidity, economy doing fairly well, consumer resilient, inflation going up, but not by so much. In that, you go in and put the fuel of a rate cut. God save us. But right now, what the market is psyched by is the labor numbers and the job numbers and the unemployment benefit numbers. So we really don't know where is the economy headed. I would say the data is not strong enough. That is the trouble. So Indian corporates' borrowing costs will come down. Definitely, they will come down. But I think Mr. Das gave a fabulous explanation of how complicated this whole thing is and how many moving parts there are to the whole decision making.
Absolutely, Mr. Bagga. Lots of moving parts. And of course, Mr. Das has compared this whole scenario to the scenario that played out in the 1960s and 70s and years, hoping that, tonight's scenario doesn't really pan out worse than what was witnessed during those years. But let me come to you, Mr. Das. What the Fed does essentially impacts every country. So the decision that the Fed is going to take tonight, how do you think investors are going to look at it in terms of how the monies are going to move, especially as far as the emerging markets are concerned?
Look, I think we have this odd juncture of a lot of uncertainty and a lot of like we were discussing before, a lot of structural change magnified by this uncertainty and all the rewiring that the Trump administration is trying to do domestically and in the rest of the world, and yet the asset markets and risk premiums are doing very well. Many of them at record levels, and I personally think that is going to continue. Because I think what is happening here is a kind of stalemate in a number of the things that the president was trying to do very sharply and very radically, whether it's the trade war, the tech war, if you want to call it that, with China, and the trade war and elements of the tech war with many other parts of the world. He's overshot and stepped back and thereby taken a more gradualist approach. And so, there's this trade conflict with China continues, trade conflict with Canada and Mexico, to some extent with Europe, significantly with India, although that appears to be improving right now. All these things are proving to be worse than they were before from the point of view of globalization, but better than the threat. So it looks like there's a bit of a stalemate in all these factors. And so the markets are, in the classic phrase, climbing the wall of worry. And I think that's going to continue for emerging markets, including India, because I think all of this adds up to a weaker dollar, both because the Fed is cutting more than was expected. It seems likely to cut more than was expected just a few weeks or months ago. And also because I think investors are reassessing their overexposure, their concentration in exposure to the US, and rebalancing portfolios to some extent towards Europe, some extent towards China, to some extent towards emerging markets more broadly, possibly including India. So I think that's going to continue. The dollar is going to continue to soften. The stalemate's going to continue. And the worries are going to remain, and the markets are going to continue to climb because we have easier monetary policy and a softer dollar than otherwise.
Mr. Das, in fact, one final question. Let me pose that question to you, Mr. Bagga. Now, gold typically has a negative relationship with bond yields because for most of the demand is for investment purposes. And right now we see gold is at record highs. In your opinion and in your analysis, do you think gold prices are going to rally higher given the kind of geopolitical turmoil and shifts that we are seeing?
Yeah, I think there is a very significant shift in gold away. People are moving away from fiat currencies. Central banks used to buy 100 to 200 tons of gold a year. Last 4 years, they have been buying 1,000 tons. The Russian and Chinese are not exporting any of their production, which is again a very significant amount of about 600 tons. The Russians and Chinese don't export it anymore. So supply is low, demand is high, and central banks are buying. The Chinese investor who used to put money in the Chinese property and flip multiple properties has moved to gold over the last 1.5, 2 years. Indian investors have been putting strong amounts as well. So good demand for gold, supply has not gone up, and also the de-dollarization move after the seizure of the Russian FX reserves by the US, Europe, and Japan. Quite clearly, a lot of emerging markets have been moving to gold. So structural trends for gold, normally you would say the big question I keep asking myself is it 79, 80? Will we see a peak and then not see gold really give returns for multiple years? Or is it like 2011, again another peak, and then we traded water for some time? But right now, it's looking red hot. Positions are quite strong in gold. And these trends, underlying trends of central bank demand, de-dollarization, the Chinese investor buying gold instead of property, I think these are huge trends which are keeping gold lofty. And we expect it to stay lofty, especially given the lack of discipline in governments, which run very huge fiscal deficits and are really staring at huge debt to GDP levels. So there, again, the gold is being helped. There was an interesting study by Goldman, I think early this week or last week, where they said even if 1% of the private market for US bonds moves to gold, we are looking at $5,000 gold in a very short period of time. Again, correlate back to 7.6 trillion sitting in money market funds in the US. Used to be 3.5, went to 5, now sitting at 7.6 trillion. Lot of liquidity globally is waiting for yields, and you cut rates, gold goes up, softer dollar, gold goes up. I think lot of trends, lot of flows are in favor of gold.
In fact, you make very important points there. But for the moment, that's all that we have the time for in terms of how we're decoding this. What's going to happen? Well, it's a matter of time where we look ahead to it. But Mr. Bagga, Mr. Das, thank you very much once again for taking the time out and joining us here this evening on India Tonight. But for now, we're moving on to more that we are tracking clearly here on India Tonight.